We have often observed that companies use corporate actions for several reasons. In this capsule, we learn about corporate actions, their need, and their impact. What exactly are corporate actions? A corporate action is an event that brings material change to a company and affects its stakeholders. In short, a corporate action is an event initiated by a public company that affects the securities issued by the company. Stock split, dividends, bonus, mergers and acquisitions, spin-offs are a few examples of corporate actions. Corporate actions are of three types: mandatory, voluntary, and mandatory with choice. Mandatory corporate actions include cash dividend, stock split, mergers, pre-refunding, bonus issue, and spin-offs. Voluntary corporate actions include right issue and buyback offers. Mandatory with choice corporate actions are the ones where shareholders are being presented with options. An example is cash or stock dividend option with one of the options as default. How do companies use corporate actions? Firstly, a public company declares dividend to be paid on each outstanding share, or it can be in the form of coupon payments to bondholders. Stock splits or reverse stock splits increase or decrease the number of outstanding shares to decrease or increase the stock price respectively. Lastly, corporate restructuring involves restructuring of business segments through mergers, acquisitions, and so on. Some corporate actions such as dividend and coupon payment may have a direct financial impact on investors. Corporate actions such as stock split may have an indirect impact, as the number of shares increases and the share price decreases. Some corporate actions like name change have no financial impact on investors. Let's look at the impact of a few primary corporate actions. Both stock split and bonus issue increase the number of shares with simultaneous decrease in price per share, which means they both do not affect the market capitalization of the share. A rights issue, which is an issue of new shares for cash to existing shareholders in proportion to their existing holdings, may lead to decrease in price of the stock. This is because the number of shares increase in the market. Dividend declaration is a corporate action in which management distributes a part of the company's earnings to the shareholders. This positive news may lead to increase in price of the stock. Buyback, which is basically reacquisition of a company's own shares, reduces the number of shares, resulting in rise in earnings per share.